US President Donald Trump has warned Iran that time is running out over nuclear talks, saying that the next attack will be far worse. This follows the arrival of the USS Abraham Lincoln aircraft carrier and other warships to the region.
Hello and welcome to The Week Ahead on Nomura Podcasts. I'm your host Andrew Tysest from our Global Markets Research team, and today's Friday the 30th of January. Well, the first month of the new year is now almost behind us, and it has certainly started with a bang. Trump headlines have come thick and fast, with markets now considering the situation with Iran, as noted there by Anya Coopers-McKinnon from DW News. Just as one issue seems to die down, another pops up, a tricky whack-a-mole game, as it were. And while the headlines from Trump continue, politicians elsewhere and markets too are responding. In the short run, the market is a voting machine, as Benjamin Graham said many years ago, and the US dollar has moved lower and gold and silver sharply higher. Not entirely a Sell America theme, with US equities holding up and US bond yields pretty steady too, but some concern evident there nonetheless. So this week we'll chat with Jeremy Schwartz from Nomura's research team in New York. I want to ask him about that weaker US dollar, as well as this week's FOMC meeting and payrolls data ahead. I should flag some risk, by the way, that a partial US government shutdown, which would actually include the Bureau of Labour Statistics, could delay release of that payrolls report. Now, we've also seen the announcement this week of an historic India-Europe trade deal following an incredible 20 years of negotiation and perhaps pushed across the line by Trump himself, an unintended consequence. So Sonal Varma will be along to talk about that and to talk matters monetary and fiscal in India, with a budget and central bank policy meeting there coming up. But let's not forget Europe. We have central bank meetings to look out for there, both from the Bank of England and the ECB, with the stronger euro making things a little more interesting too. So I'll chat with Andres Stepaniak from our London-based research team to get the lowdown there. And finally, on central banks, I'll squeeze in a quick word at the end. We now have the Reserve Bank of Australia delivering a 25 basis point rate hike next week, following stronger than forecast core inflation data this week. So I think that's worth a mention. A lot to get through, so let's dive in.
The dollar plunges to its lowest level in nearly 4 years after President Trump says he is not concerned about its decline.
Okay, so let's kick things off in the US, and we have Jeremy Schwartz, senior economist from our New York-based research team, here with us. Hey, Jeremy, welcome. I hope you're keeping warm over there.
Yeah, it's great to be back.
Okay, excellent. Hey, let's start with the US dollar. It's had a move lower this week, as noted there by Jumana Beseche from Bloomberg. But Mr. Trump seems very relaxed. So I wanted to ask, what's your take? Is the administration seeking a weaker dollar? And does that have any sort of impact on macro thinking?
Yeah, so, we had some back and forth, the administration, with Trump seeming to talk down the dollar, or at least sounding comfortable with a weaker dollar, before Treasury Secretary Bessent reaffirmed the strong dollar policy, which has been a mainstay of the Treasury for many years now. But I think if you listen carefully to what Bessent was saying, he's really defining down the strong dollar policy, essentially saying, we'll do what's good for growth in the U.S. domestically, and over time that should work out. The money will come in due time. I think that suggests that, while the administration might stop short of actively seeking to weaken the dollar, they're certainly comfortable with a little extra stimulus for domestic manufacturing, a little bit of easing in financial conditions. And really, it's been a consistent theme for Trump throughout both terms of his presidency, that he's often spoken positively of the benefits of a weaker currency, and sometimes complained about trade partners doing too much to devalue their currencies, as if that were giving an unfair advantage. So we do think that they're going to try to stimulate the economy however they can. We've seen that in attempts to pressure the Fed. We've seen that with fiscal stimulus and attempts to ease financial conditions. And I think some tolerance of a weaker currency is really in a vein with that run it hot policy.
Okay, that's really great, Jeremy. I think that's a great answer. Really good, helpful to get your take on that. Hey, another highlight this week was the FOMC meeting. Of course, there were no particular fireworks, I guess, but could you give us a quick recap? What did you see there, and what's your outlook for the Fed?
Yeah, so as you mentioned, no fireworks on the big policy decision. A hold was widely expected. It had been well telegraphed. We saw the committee, I think, do the bare minimum to market based on some recent generally positive data we've received. There was some upgrade to the growth outlook, some upgrade to how they were assessing the labor market. But I would say our takeaway from this meeting is that Powell is still quite dovish. He did say the labor data was getting better, but then he kind of went on to emphasize some I'd say more niche or second tier indicators, which are continuing to show some signs of weakness. Things like the Conference Board labor differential or U6 underemployment. So they still seem to be very sensitive to any signs of cracks in the labor data. And at the same time, he seems quite optimistic on inflation. Saying that were it not for tariffs, you'd effectively be at the 2% target already, saying you were getting disinflation in every category of services prices, a characterization which we would dispute and certainly isn't as clear as he made it out to be, expressing a lot of optimism that inflation does cool through the year. So our call on the Fed remains unchanged. We think they're on hold through the remainder of Powell's term as chair through May. But that's largely a call based on the data. I think the reaction function is still quite dovish. It's still very sensitive to any kind of labor market weakness. So we think there is that asymmetric risk there, where if you got a downside surprise in the labor market, they'd be a lot quicker to react to that than if you'd got a upside surprise on growth data or on inflation.
Okay, got it. So I guess patient near term, but on the dovish side with that downside reaction, as you say. And look, finally, Jeremy, just turning to the week ahead, there's a number of data releases, but payrolls is probably the highlights. Could you share some quick thoughts with us on that one?
Yeah, so we've seen lead indicators for the labor market broadly improving over the past couple of weeks. Initial and continuing jobless claims have trended lower. We've seen service sector surveys generally showing better employment growth. So we're thinking that you do get some modest acceleration in headline payrolls up into the kind of high double-digit range, something around 85K overall. That would be the fastest pace since September of last year, and it would bring the 3-month average up to the highest since the first half of last year. So we do think fundamentally the labor market is stabilizing and beginning to pick up some momentum. We think the unemployment rate is a close call this month. We think there's a good chance that it ends up rounding down to 4.3. It's on the cusp already, and even though some of the data on labor demand is a little bit soft, things like that labor differential, the slowdown in jobless claims makes us think that the trend there should be lower, kind of over the near to medium term. We think wage growth stays solid at 0.3, which is really consistent with the past 12-month trend. We haven't seen wage growth really going anywhere. It's running at a pace that's a little bit higher than the Fed should be comfortable with. And then just to flag, there are a couple of technical adjustments that are going to be happening in this report. Most importantly, this will be the final announcement for the annual benchmark revision for last year. We expect that's going to bring the average run rate for NFP through March of 2025 down by around 75K per month. So that was well telegraphed by the announcement in September of their preliminary estimate for the benchmark revision. But in this report, it's actually going to finally be incorporated into the data.
Okay, Jeremy, that's great. Thanks so much. Hope you have a great week ahead.
Yeah, you as well.
Now, let's move to Asia, and I'm joined here by Sonal Varma, Nomura's Chief Economist for India and AEJ. Sonal, thanks for making the time.
Thanks a lot, Andrew.
Excellent. I thought we'd start with this historic India-EU trade deal. I believe Ursula von der Leyen called this the mother of all deals. That caught my attention. But can you sketch out some contours of this deal for us?
Yeah, so actually this deal has been 2 decades in the making and, finally clinched as I think both India and EU are clearly trying to diversify their export partners and hedge against the US. Now, the ratification actually of this deal will take up to 1 year. So we're looking at implementation timeline of roughly 2027. But the deal, yeah, it involves substantially lower tariffs by both sides on the goods. It also includes opening up services sector. There's a defense partnership that has been signed. From India's perspective, actually, it opens a wide market for its labor-intensive exports. So it allows actually India to integrate into the EU-centric global supply chains. And from EU's perspective, it provides them access to a large and growing market in India. So lower auto tariffs will actually benefit the European firms. So we've made some estimate on this. For India, we think the deal can add about 0.1 percentage points to India's GDP growth in year one, with this boost potentially increasing to 0.2 to 0.3 percentage points by the fourth year. From EU's perspective, our European team's estimate is it can raise the level of EU GDP by about 0.1 percentage points. So yeah, it is the mother of all deals.
Hey, that's great. Yeah, it looks like a nice win-win, gains from trade. Hey, sticking with India, there seems like there is a lot going on, monetary and fiscal. You've got an RBI policy meeting coming up and the budget soon too. Could you share some quick thoughts on those?
Yeah, so the fiscal will be in focus first. We have the budget this Sunday, that's 1st of February, and RBI policy is later during the week. So on the budget, actually, this is the first year where we move from deficit to debt targeting. And we think the government will show a lower central government debt target of 55% of GDP from 56% this year. And also some fiscal consolidation. So a target fiscal deficit of 4.2% of GDP from 4.4%. Now, there are many things to watch in the budget, depending on, who the investor is. So from bond markets perspective, the focus will be on gross market borrowings, which we think will be on the higher side. Equity investors will focus on the sectoral focus areas. So we think, for instance, capital expenditure of the government that will be maintained at 3.2% of GDP. And there'll be other focus areas. So focus on boosting manufacturing through an expansion of what is called the production-linked incentive scheme, larger capital outlays for defense, further push on critical minerals supply chain resilience. And also we're looking for rationalization of custom duty slabs. And finally, I think we could get some announcements on reforms around either ease of doing business, regulatory reforms. So on the whole, we think the budget will show a gradual fiscal consolidation, and in general, it'll be more medium-term focused and stability focused. So that's the budget. And then during the week, yes, we do have the RBI, where we and Consensus are looking for the policy repo rate to be on hold. We think it's going to be a dovish to a neutral hold, with the RBI's forecast essentially showing inflation at target and growth closer to potential over the 1 year horizon. I would say actually more than the policy decision, it's the other stuff which is going to be important. So, our focus will be on what kind of durable liquidity injection measures the RBI announces, because policy transmission has been a major issue. So we are expecting a durable liquidity injection worth about 1.5 trillion INR to be announced through a variety of instruments, such as through open market operations, i.e. government bond buying, and also through long-dated repo operations. The other thing we'll be focused on is the RBI's communication on FX. Because, INR has been under depreciation pressure. So whether the RBI is happy with that or they think we're already at fair valuation. So I think any comments around that would actually be quite interesting.
Okay, good one. Thank you. You covered a lot of ground there. I guess there is a lot going on. And FX is a bit of a theme this week for us as well. So great to get your thoughts on that one. And so, look, just finally stepping back a little bit from India, looking across the broad Asia region, I guess there's a few things on the calendar we could chat about. But one that caught my eye is inflation data. There's a number of releases across a number of countries. So I did want to ask, are there any themes there or any particular countries which look interesting to you?
Broadly speaking, Andrew, I think there's actually a lot of data that's coming out. But one thing is we need to be careful on Jan data interpretation because we're getting into this Jan-Feb period where you have data distortion because of the Lunar New Year effect. So it basically falls entirely in February this year, but it fell across Jan and Feb last year. So there is a change in the working days. So essentially, our estimate is that the Jan reading of CPI inflation for many countries will be biased down, whereas activity data like exports and industrial production will be biased up in Jan. It's going to be the reverse in February. So with that in mind, the Jan CPI numbers that we will be getting next week for a number of countries, we think will show a moderation. And of course, the underlying trend has anyway been benign, but the Lunar New Year effects will exaggerate the numbers on the downside. So that's one thing to keep in mind. I think one of the standouts in the region we think will be Thailand, where deflation we think is going to deepen. So we're expecting CPI to go from minus 0.3 to minus 0.8% on a year-over-year basis. And the boost to exports should also be visible in Korea's Jan export numbers. So that we think will be up almost 35% on a year-over-year basis. So that's massive. So Korea is, of course, benefiting from the chip upcycle. But again, the higher working days will also exaggerate that boost. So that's that. I would say Indonesia is also in focus. We saw some huge market moves this week. On the macro front, unlike the countries, most other countries in Asia, we actually think CPI inflation will pick up in Indonesia next week. So we're looking for headline pickup from 2.9 to 3.6%. It's more technical in nature, so it's essentially reflecting the fading of the electricity tariff discount from last year. And we'll also be getting the fourth quarter GDP numbers in Indo, expecting a slight improvement to 5.1% from 5%, mainly because of government spending. And the final thing to watch actually will be, we have the general elections in Thailand next Sunday, so that's 8th of February. So polls currently show the opposition People's Party in the lead, but we think that it'll be unable to form the next government. So we see political uncertainty actually weighing on growth in Thailand.
Wow, Sonal, that's great. So much going across the region, but you're obviously across it. Hey, thanks so much for coming on the podcast.
Thanks a lot, Andrew.
Now let's turn to Europe. I'm joined here by Andrei Stepaniak from Nomura's London research team. Hey, Andrei, thanks for joining.
Hey, Andrew. Good as always to chat with you.
Excellent. Thank you. Look, I thought we'd start with currency. I've been noting the weaker US dollar, but stronger euro is the flip side of that, or one flip side of that, I guess, and we've just touched 120. What does the stronger euro mean for Europe?
I mean, look, obviously a stronger euro versus the dollar is certainly important in the euro area from an inflation perspective. It certainly adds to the sort of disinflationary pressures we could see. Recall you had euro dollar appreciation during the first half of 2025. We're sort of still seeing that feed through into core goods prices. I mean, the sort of 120 level you mentioned, I think it's quite important in investors' minds purely because Guindos, so the current vice president of the ECB, he actually mentioned this as a level at Sintra last July, so in July 2025, and he said essentially 117, 120, they're sort of challenging but acceptable. Anything beyond 120, and that could make things tricky for the ECB from that perspective. And likewise, earlier in the week, we also had Kocher, the Austrian central bank governor, who spoke about the fact that essentially if the euro dollar keeps on rising, it might force the ECB's hand. Obviously, they don't target the exchange rate. Lagarde has made that clear time and time again. But a meaningfully stronger euro dollar could obviously result in a quite hefty downside surprise in inflation over their forecast horizon, and that's what could induce them to potentially cut rates further if you're sort of thinking down that sort of framework. It is worth noting we did actually launch an investor survey, and we asked essentially the question, at what level of euro dollar do you think the ECB would consider cutting interest rates again? About 28% of respondents said 125, so we're a fair bit away from that, given the fact that it seems to be capped at 120 for the moment at least, and our FX strategists, their baseline forecast is 120. And then 23% said 130 is the level the ECB would really have to be concerned about. That said, obviously, it's not just the FX that's moving. You do as well have the rally in oil prices that we've been seeing. And it's worth noting, actually, from the ECB's perspective, at least, looking at their rules of thumb, I mean, it almost feels like the sort of old classic economist thing. But so on the exchange rate, they say a 10% appreciation in the euro will lower headline HICP inflation by around 0.4% within a year. So basically, a 10% has a 0.4 percentage point impact on inflation. And then in terms of oil, they estimate a 10% change in the oil prices leads to a 0.4 percentage point impact on headline HICP inflation directly through energy component, and then an approximate 0.2 in the 2 to 3 years afterwards on core goods prices. But so just taking those sort of headline figures, it does seem that the recent moves in oil and FX, certainly when you compare to the baseline expectations in the ECB's December forecasts, net each other out.
Okay, so that is interesting. So, yeah, we are looking at substantial swings in currencies and in commodities. And, yeah, with the ECB meeting next week, this will be interesting to see what they make of all of this. But just to square this off, Andre, can you confirm we're looking for no change from the ECB? And in terms of the communication, do you think it will be like dovish or hawkish?
Look, in terms of the ECB, you're very right. We're forecasting no change in policy whatsoever. We actually have essentially no change in policy penciled in this year and next year. In some senses, the ECB should, touch wood, be pretty boring. It's not a forecast meeting, but clearly you're going to get a lot of questions from the journalists in the press conference about the euro dollar, about the news in oil. And we think Lagarde will be very clear that the ECB does not target the exchange rate. And obviously, in terms of oil, it'll impact their March forecasts, but she'll clearly say we have to wait for those to occur. Look, in terms of the guidance, they're going to sort of emphasize data dependence. They're going to sort of maintain their meeting-by-meeting approach. I mean, if you look at, say, the ECB speaks since the December meeting, almost every single governing council member has basically said that the ECB is in a good place. Rates can remain on hold. I mean, actually, even one of the so Lane, it was one of the so Lane, who's the chief economist, he said the other day the current rate level delivers a baseline for the next several years. Obviously, you can't forecast a shock, but if basically you have growth at trend or pre-pandemic trend rates, if you have inflation hovering around the ECB's 2% target, and that's your forecast for the end of the forecast horizon, in the ECB's case, until end 2028, I mean, there's no reason to change policy, in their view at least, over those 3 years.
Yeah, okay. Growth at trend, inflation at target. It sounds pretty nice for a central bank, but I guess there's a few extra things to look out for there, as you noted. Hey, Andre, finally, last question. Let's just jump across the channel. Bank of England is also out next week. What are they going to say?
Look, in terms of the Bank of England, we're forecasting no change in policy. So generally speaking, we're expecting a 7-2, so 7 in favor of unchanged, 2 in favor of a rate cut. That's, I mean, also it is a forecast meeting, so they'll be watching that fairly closely. But generally speaking, from the Bank of England's perspective, our view is the next time they're going to cut rates, and we think we do pencil in one further cut, that's in April. So basically, it'll remain on hold until the April meeting and bring bank rate down to 3.5%, the sort of upper end of where we sort of see neutral in the UK at least.
Okay, so that is pretty interesting. Real divergence, I guess, going on. We've still got ECB on hold, but Bank of England to cut, and a couple of cuts from the Fed too, while others pressure's clearly upwards. I guess it keeps things interesting for us. Hey, Andre, let's leave it there. Thanks so much.
Thanks, Andrew. Good as always. Talk to you soon.
And finally, just a quick word on Australia with the RBA's policy meeting next week. This week down here, we saw core inflation print above its expectations, and this follows stronger than forecast GDP and an unemployment rate which is lower than the RBA had been expecting. We think that CPI data is going to tip them across the line such that they will now feel compelled to deliver a 25 basis point rate hike next week. This flow of data, I think, will add to its concerns that policy is not as restrictive as it had earlier thought. But I don't expect this to come across as a hawkish hike, and we don't think it will give a lot of forward guidance suggesting that more hikes are likely. More recent Australian data seems to have turned a bit more mixed, and I think this hike will come as an unwelcome surprise for consumers following a couple of rate cuts last year, which had left them hoping for more. The RBA's updated forecasts too, while reflecting a stronger starting point, will also reflect a higher exchange rate and a much higher market path for the cash rate. And first principles would tell you that that should pull down their longer-term growth and inflation forecasts as well. Okay, so there you have it, our views on major market themes and what to look out for next week. This podcast has been written by Andrew Tysest and the Global Markets Research Team, and expertly edited and produced, as always, by John Dalton. Thank you for listening in. If you did enjoy this podcast or would like to hear more, please like and subscribe to Nomura's podcasts on Apple, Spotify and SoundCloud, or wherever you get your podcasts. And if you have a moment, please leave us a review. And as we always say, it would make our day if you could press a few buttons and share this podcast with a colleague or a friend. For more, log into nomurakonnects.com to keep up to date and to keep on listening. Thanks, goodbye for now, and see you next week.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision, and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice, nor is legal, regulatory, accounting, or tax advice, and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomurakonnects.com.